Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Wednesday, so we typically look at some of the charts in container leasing and trading, essentially how the market is moving throughout the week. Let me quickly share my screen to give you a little bit more guidance of what I'm talking about. Of course, key factor in consideration of everybody right now is the question of how will rates, so that is freight rates as well as container leasing rates and container prices, how will those rates and prices develop post-Chinese New Year? As a reminder, Chinese New Year ended on about 2.5 weeks ago, on the 19th of February. And since then, activity in China has resumed, and with it, essentially, the global container logistics world as well. Now, what we see on the freight rate side, and I don't have a graph here for you, but what we see on the freight rate side is that rates are starting to soften across the world, across the globe, as carrier networks have readjusted to the new normal post the closure or partial closure of the Suez Canal because of the Houthi attacks. So the capacity that has been soaked up by the diversions around the Cape of Good Hope, carriers have adjusted to it. So now we do see, in line with expectations, freight rates continuing to or starting to soften from their heights. Of course, the big question is for us on the container side, what will happen to container leasing and trading rates? And the answer is, well, they are starting to soften, but they hold up surprisingly well. Let me just quickly jump to this tab. These are our container leasing price trends. So these are one-way moves, 40-foot high cubes, Shanghai to, in this case, Long Beach and Houston. And these are the one-way charges that you see here from January last year to March, so basically the current week. What we do see is that rates have started to increase already since the middle of last year, also a little bit driven by demand for shipping containers in Shanghai for exports into Russia, so a very imbalanced trade. And then they have shot up here since the end of 2023 because of the diversions around the Cape of Good Hope and the soak up of capacity. And since then, we see some indications of softening here. Rates have come down a little bit, but overall, they do hold up quite well. And of course, some of this is also driven by sort of local demand. And as I said, sort of a demand for exports into Russia and other Asian locations. The same picture actually on the trading side, although there we can differentiate a little bit more across regions. What you see here is now, again, 40-foot high cargo-worthy boxes in these locations. So I said Hamburg, Jebel Ali, Rotterdam for sort of Middle East and Europe, and then Ningbo and Shanghai as container price indicators. And what you see is that Shanghai and Ningbo are, of course, leading the pack, and actually prices are continuing to increase. And these, again, are trading prices, second-hand trading prices. And in other locations, namely Europe and the Middle East, prices are starting to soften also since the beginning of 2024, in line with expectations. So a little bit of a tale of two worlds. This, of course, will also have an impact here, this delta, on the one-way leasing rates between these locations. Of course, they are there also to balance out any price differentials. So very, very interesting actually here to see and follow the developments. And of course, the question is, how will the next 3 to 6 months, I'd say, play out? We still expect container prices and correspondingly leasing rates to start to soften. Container prices first, leasing rates second, because they are also impacted, as I said, by price differentials and not just absolute container prices. Well, that's it from me, from us for today. Thanks a lot for tuning in. Have a fantastic rest of the week and see you on Friday. Take care.